Good morning, everyone, and welcome again to the FY21 Janison Investor Update. I am your moderator for today, and I will be handing over shortly to our CEO, David Kaspari, and CFO, Stuart Halls. Please note that your microphone is muted and your camera is turned off throughout the duration of this update. After the update, around 11:50, we will have a 10-minute Q&A window in which we'll have a look at any questions you may have. If you would like to ask a question, please use the chat function in Teams and formulate your question there. Please note, this session will also be recorded. I will now hand over to David Kaspari, CEO from Janison. Over to you, David.
Thank you, Sona, and welcome to all of our investors today for Janison's FY21 Investor Update. Before I get started, I just want to send my wishes to all of you, your families, your loved ones through what is an extraordinary time, and just want to make sure that you're looking after your well-being, keeping yourself healthy and navigating this time as best you can. It's my pleasure today to present Janison's operational and financial results for FY21, and it's an exciting time for Janison. We've announced some great financial results today, the results of a decade maturing, perfecting our capability, as well as the transformation that we began almost 18 months ago. In particular, we've reshaped our portfolio to focus on our suite of school assessments products and on our assessment platform. And a portfolio now that collectively delivers on our promise, which is to unlock the potential in every learner. Our strong focus in the last 14 to 18 months has been on operational execution, on customer experience, and on our growth drivers of PISA for schools, our ICAS products, and our Insights core assessment platform. And that's enabled us to deliver a record year, a record in revenue, a record in annualized recurring revenue dollars, a record in annualized recurring revenue growth, and a very strong cash position. But most pleasingly in our key metrics of assessment, annualized recurring revenue growth, and gross margin expansion. I'm so proud to be leading Janison and working with our board and an extraordinary and diverse team. And we've now established firm foundations that we know will unlock our sustained performance over the medium term. So many of you have been on the journey with Janison since our listing in 2017, but that said, we've seen a very significant lift in our investor register in the last 12 months. So for that reason, we're going to be stepping through a company overview, followed by our highlights of the year that's passed, our financial results, an outlook for FY22, and then beyond that in a horizon, and then a very short deep dive on our key growth engines. So for those that are new to Janison's story, we're a leader in digital assessments. And that's important because from a market standpoint, it places us very well where school assessments is a core piece of the rapidly expanding schools EdTech market, and where schools represent more than half of all of the education TAM or target addressable market. It creates an enormous opportunity, and we're only at the start of what we believe is a 10+ year growth cycle in the digitisation of assessments and the taking of assessments online. A core piece of Janison's differentiation, a core piece of our IP, is our standard assessment platform called Janison Insights, and it's been built and perfected over the last 10 years in partnership with some of the largest jurisdictions such as the Australian Commonwealth, New South Wales Department of Education, the Singapore government, and other large jurisdictions. And what it means is we're now a flagship in the market, in a market where the barriers to entry are very, very high. Our assessment products, which also sits on that platform of the ICAS portfolio, but also our PISA for Schools partnership, are flagships and differentiated in the market. And our assessment platform has set all sorts of benchmarks in FY21. We delivered 6.5 million digital exams in 117 countries. And our platform as a standalone platform with NAPLAN set the global benchmark for high volume, high stakes exams. Many people are asking us what COVID is doing to the dynamics in our business. And as our FY21 results have demonstrated, our business is not just resilient, but we're seeing shifts and accelerations and permanent adoption of digital and online assessments only accelerate as a result of COVID. As I said before, one of our key metrics is ARR growth in our assessments portfolio. And our three core growth engines that drive our assessment ARR are PISA for schools, ICAS assessments, and customers on our assessment platform. And I'm delighted with the performance of all of those in FY21. PISA for schools continues to flourish, and we see an opportunity in the medium term of that being a $30+ million per annum ARR partnership with the OECD and with dozens of countries around the world. ICAS assessment has had a very successful year, particularly with the ICAS competition, and it's poised for further growth in FY22 and with a medium-term aspiration and objective of $20+ million per annum. And our assessment platform business has gone from strength to strength. We see that as having a horizon target of $20+ million as well. We saw 6 new logo customers join Janison on our assessment platform, including Australian New Zealand Chartered Accountant, a $5 million plus TCV, $1 million plus a year partnership in business. Expansion in key strategic customers such as New South Wales Department of Education, I'll cover that a little bit later. Expansion in roads and maritime services. Benchmark performance and a very successful NAPLAN 2021. And true innovation with SKIO in the Czech Republic and the University of London, where we helped those organisations go online for high stakes tests in a remote proctored form in the middle of COVID. Our commitment to equity is at the core of everything we do, and our founder, Wayne Holden, more than 20 years ago was a teacher, and he really created our founding ethos, and that is that all learners deserve the opportunity to realise their potential. And that's now encapsulated in our reimagined purpose, which is to unlock the potential in every learner. And I do want to stress the word every, because every is a very precise statement that speaks to our commitment to equity. Whether people are in some of the wealthiest socioeconomic countries with access to technology, or whether they're in some of the poorest locations, nations, or where internet access is poor, our purpose is to be able to provide the same experience and to unlock the potential across all. And we've embedded it in our technology, whether it be low, no bandwidth technology, which allows Indigenous communities in the Northern Territory to participate in the likes of NAPLAN, even though internet connectivity is poor, to our branching technology, which means independent of learner knowledge and skill set, they can find the right assessment pathway that allows them to be assessed and the insights to be gathered. And it's been a very successful and transformational year for Janison. We scaled our sales and marketing investments and capability, as we said we would do, from 8% of revenue to about 16% of revenue. We accelerated our product development. We brought significant new talent in the company, including a refreshed leadership team, an extraordinary leadership team. We clarified and simplified our strategy, which is now clear and very simple and anchored on PISA for schools, ICAS assessment, and our assessment platform. And we've now established a very clear path to an 80 to 100 million annualized recurring revenue horizon. At the final weeks of the year, we also had a heavily oversubscribed and successful capital raise. So why Janison? Well, as I mentioned at the start, our platform has been developed in partnership with jurisdictions at a national level, at a state level, and at a global level over many years. And high stakes, high volume assessment is very different to, a year 6 teacher running a quiz for her classroom for 20 kids to understand where they are. What we do is where organisations, large jurisdictions require an organisation they can trust to provide an assessment experience end to end, high stakes, high volume. When it matters most, you come to Janison. And our assessment platform is also highly configurable. Even though it's a standardised platform, the experience and the development we've done through some of our largest customers means we have flexibility to meet the needs on our standardised platform of almost every customer need in the high stakes, high scale market, a market where there are very significant barriers to entry. And in terms of functionality, it directly addresses some of the key pain points that organisations have. At its very core, what we do is better and provides better insights than pen and paper exams. But it also puts data in the hands of educators almost immediately, which allows them to make the interventions and to drive learner improvement. Because teachers and administrators use it, it has to be simple. And it also integrates into their existing learning management and other student management systems. Ultimately, it puts the data and the insights into the hands of educators when they need it most. And I'll talk about a great example of that in our partnership with the New South Wales Department of Education in the last 12 months with our check-in assessment. Finally, unlike at any other time before in this space, integrity and security really matters. As we grappled with helping organisations take their high stakes assessment online and remote, the biggest question is, how can you secure my data? How can you ensure that the integrity of a high stakes assessment meets our needs? And whether it's for NAPLAN, whether it's for taking chartered accountants online and remote, whether it's for SCIO, where we ran the university entrance exams for the entire Czech Republic, our credentials on integrity and security and high stakes are unparalleled. So if we move forward, it's now my pleasure to step you through some headlines on our FY21 highlights, which arguably has been the best year in Janison's history. Our OECD partnership continues to flourish, and we've now partnered with the OECD and in 15 countries, and we'll deep dive on that in subsequent sections later today. What that does is it establishes a very firm annualised recurring revenue base in FY22 and beyond. We had our first successful delivery of ICAS with almost 300,000 tests and $5 million in new revenue, which exceeded even the highest expectations of management. And we realised a number of milestones for the company. $30 million of revenue passed for the first time, 9 percentage points increase in gross margin, which is an absolute core lever for us to 55% gross margins on the way to those true platform and SaaS gross margin measures. And very pleasingly, a non-financial measure, but a very important cultural measure is for the very first time, we achieved workforce gender balance, and we now have more than 50% of our entire organisation being female. And, diversity goes far greater than just gender diversity. But it also is an important dimension, and we're very proud that we've reached this pleasing milestone. As we go through the rest of the presentation and we address questions later on, you'll hear us talk about our two key financial metrics that we orientate ourselves towards. The first being gross margin expansion, and we just spoke about a very positive gross margin expansion story from 46% to 55%. And Stuart will later talk about how we can take 55% up into the 60s and to the 70s through our growth engines. But the second key metrics we orientate ourselves towards is assessment annualized recurring revenue, because the combination of assessment ARR and gross margin expansion makes us very sustainably cash generative in the next few years. And you can see as we unpack our full year group revenue below that headline $30 million revenue for the year, you can see our growth is coming from the right parts of our business, our assessment platform and our assessment products. And we are happy to be able to communicate and share a 117% year-on-year increase in assessment ARR. what we would like to continue to orient conversations on in the future is not just growth, but the quality of growth, the mix, the margin, and the component of our business that is growing. At this point, I'd like to pass over to Stuart Halls, our CFO, to take us into a little bit more detail on FY21 financials. Stuart seems to be having some challenges at the moment, as is the COVID world when we work on Teams. What I will do perhaps is move forward to our FY22 outlook, and then I'll ask Stu to come back to the FY21 financials once we have our technology back on track. As you've heard just now, we've had very pleasing FY21 results. And in FY22, if we go to the next page, we expect to sustain this momentum from FY21 into FY22. We expect to see continued sales momentum, and we're continuing to see very strong pipeline growth, and I'll step through the components of that in a moment. ICAS, our sales campaign for ICAS 2021 is progressing very, very well. We're right now at the very beginning of our ICAS 2021 year delivery. And we're already seeing tests run. Even through COVID, we're seeing almost 20% of currently sold and purchased tests have now been completed for ICAS 2021. In PISA for schools, we expect to see significant expansion in the 15 countries where we're already accredited or have partnered with a national service provider to take PISA for schools to market, and we will go into that later. And in our assessment ARR and our platform customers, we continue to expect that we will expand our existing customer installed base, as well as bring new logos on board, both domestically, but we now expect that we will start to see some additional international new logos in our assessment space. As a function of that growth and the growth mix, we will see acceleration of our gross margins, because we will see, because our gross margin mix in ICAS, PISA for schools and our assessment platform naturally changes our margin percentage up. Now, school lockdowns is obviously a critical question that I'm sure you'll raise. You can see that in FY21, our business has been very resilient to COVID. And in fact, what we've seen is, while we've seen some pressures in our business as a result to lockdowns, we've also seen at least the same of new opportunities being created. In fact, right now, this minute, we're running remote HSC trials for students in New South Wales to help them get through this COVID crisis and provide them with educational continuity. So, Stuart, Teams has crashed and you're back on.
Yeah, sorry about that. I'm not sure what happened. Just as I was expected to start, it all crashed. So apologies to everyone.
That's like plans. So why don't we go back now to FY20?
Yeah, let's just jump back, Sana, to the financials, and I'll take it from there. Sana, do you want to just go back up to the FY21 financials? That's it. Keep going, a couple of slides up. Yep, perfect. All right, so just moving on to the next slides into the P&L. Excellent, thanks for that. Look, I mean, on the whole, FY21 was a great result. You know, we saw, as David mentioned, record numbers in many areas, if not in all areas. You know, starting with revenue, we exceeded $30 million for the first time, which is fantastic. And you know, a lot of that growth was really coming from platform revenue, where we saw almost 60% growth. And that's really pleasing because, you know, as we shift our business, and we talk about this throughout the presentation, as we shift the business away from the sort of heavy project services clients, you know, with low margin, long projects, and more into the platform revenue, high margin recurring business, that's really starting to make an impact on our margins, which you'll see in a second. Overall revenue and platform revenue particularly was driven by the three key growth drivers that David mentioned. So that's the PISA for Schools program, ICAS, and adding new and expanding our assessment platform clients. Moving down the P&L to the margin lines, look really good again. So 16 million of gross profit, 66% growth, margin of 55%. You know, we saw last year in FY20 an 11-point increase in gross margin, and now we're seeing another 9 points this year. And a couple of slides, I think it's the next slide, you'll see a continuation that we've seen over the past few years of margin growth, and we'll talk about why that's happening. But again, as David already alluded to, we expect to see more of that coming into the future years as well. On OPEX, or operating expenses, we did see a noticeable increase in FY21. That wasn't a surprise. You know, we are basically setting ourselves up for growth now. We deployed capital that we raised in April 20 on the things that we said we would, which was primarily to build out the senior leadership team and also to establish a world-class sales and account management team. And the results of that team are now really starting to take effect, and as you can see in the revenue and higher gross margins, and just our ability to execute on our annual plans. That team that we now have in place has the capacity, you know, that leadership team and the sales and account management team have the capacity to deliver more on the top line. So we won't see a lot of recruitment in FY22. We'll see some in places, but on the whole, that's largely complete. However, we will see a sort of annualization impact. You know, a lot of those roles that we added this year were phased in during the year, so we haven't really seen the full year's impact of that. So we will see a step up in OPEX next year because of that. D&A, or depreciation amortization, stepped up again as well this year, but it's starting to level off now, which is good. You know, and this reflects really the last few years we've seen of higher spending on our products. You're really investing in the platform to maintain our position, but also to build out our items. So those questions that create the digital bank for our competitions like ICAS and the many other assessment products that we deliver for schools. Just moving on to the next slide. So what we've got here is a sort of 6 monthly or half year gross margin chart showing dollars in the bars and the percentage in the line. And look, again, you know, obvious to see that it's a really strong trend. And sort of really getting us closer to more of the traditional or typical SaaS platform margins that you'd expect, and that's where we're heading. I think the second thing to take out on this chart is the fact that, you know, we finished the year with a second half stronger than the first half with 57% gross profit, and that's a really good indicator as we go into FY22. I think in general, the growth in margin, you know, hasn't come about through significant price increase or, you know, dramatic cost reductions. It's come about through mix and volume. You know, we've really shifted our customer mix towards the majority of our revenue coming from customers who purchase the standard assessment platform now, or our off-the-shelf products like ICAS. You know, previously a large proportion of our revenue was from developing custom assessment platforms, you know, that generally were sort of low margin in nature. On top of that, we have seen an increase in volume, and with that volume comes a scale benefit as well in efficiency and margin. You know, on that vein, to produce the ICAS assessment and other school products, it's largely a fixed cost base. You know, and by that I mean once we sell over and above in revenue terms the cost to cover, or the amount to cover the fixed cost, you know, those variable costs associated with the incremental revenue are really immaterial, and it's only, you know, a marginal cloud hosting expense that goes with it. So that's margin. Moving on to the next slide, to look at cash flow for a moment. Again, I won't go through every single line item, but some key points to call out here are, you know, really strong customer receipts of $34 million for the year. And I think also it's worth mentioning the strength of our customers underneath. You know, we have some really high quality customers. We deal with governments, large enterprises, accreditation bodies, so very low credit risk clients. And on top of that, you know, most of our customers, in fact, pay us upfront in advance for the year ahead for their license fees. In general, you know, we are sitting on a bit more than the $23 million of cash on hand that it says there. You know, we've received receipts from the ICAS assessment that's about to kick off this month. So we're on a bit more than 23 million, and we don't have any debt, which is great. So we're in a very healthy position, and we're ready to, you know, use those funds in accordance with what we said in the capital raise in June and July, and that's to accelerate investment in our 3 growth drivers and really capitalize with that money on the opportunities that we have ahead of us with things like PISA for schools and ICAS in particular. One of the reasons why we raised capital, aside from sort of shoring up the balance sheet and ensuring we have sufficient working capital now that we're a larger business than we were a year or 2 ago, it's also to look at acquisition opportunities. And we do have a pipeline of acquisitions, and we are in discussions at various stages with different companies, and we hope that in the not too distant future we'll be able to publish news of an acquisition that we've completed on. So that's sort of it really for the financials, very high level, just picking out the key points. Obviously there's time at the end for questions, and also we can take more detailed specific questions, either through the IR email address or online. But for now, I'll hand you back over to David.
I think we'll go to, I managed to cover a lot of the FY22 outlook. So Sana, if you could step forward to the horizon. I just will reiterate, we do expect to be able to keep the momentum that we built into FY21 and FY22. And the momentum will come from those key growth drivers of PISA for schools, ICAS assessments and assessment platform growth. And as a core result of that, we will see that margin continue to improve as well.
Yeah, thanks, David. So yeah, look, I mean, I think at this point here, we wanted to look at the horizon and starting out with the market that we operate in. I think, we talk about this, but we don't really present a huge amount of detail on it. So maybe if we just go to the next slide, Sana. I think the main thing to say is that we operate in a very, very large market. We operate in the education space, and in particular in digital assessments within EdTech. The EdTech market in 2021 was valued at $268 billion, and it's growing very quickly. It grew about 18% this year, and it's accelerating, as you can see, between the difference between those two lines as a result of COVID, forcing a transition to digital delivery of assessments and learning. Of this market, schools comprises more than half. And so with that, plus our history of developing school platforms and products, for the schools market, this is why we are focused very heavily on the schools market. The other thing to note here is that the digital spend, or the EdTech spend within the education market in the bottom 2 rows is very small. We're still talking about single digits, 4 or 5% of the overall education market is digitized. And so that leaves another opportunity for this market. And we'll talk more about this later on, but the transition to digital technologies will really start to drive that share of the overall education market up. Just moving on to the next slide. So within that overall market, of the size which it is, these are some of the sort of more recent dynamics that we're seeing. One of them is governments around the world are spending up, increasing their education spend to try and address the issues that came about last year and this year through school closures, really trying to understand and identify where there are learning gaps amongst students and cohorts, and investing in tools and technologies that help teachers get back on track. And that's a great thing for Janison. We have tools and platforms that really help educators assess where those learning gaps are amongst students and help to develop interventions that improve and lift education standards for those students. In terms of technology adoption, we're seeing a fairly increased level of investment across schools and education systems and departments, increasing their technology infrastructure. Through COVID, that has only accelerated it further. And we are seeing schools very rapidly uplifting their digital capability with improved infrastructure, network infrastructure, hardware, and digital literacy in general. And then finally, for those schools that have tried to do something through COVID, by maintaining continuity in their exams, particularly those end of year high stakes exams, using hybrid sort of solutions, whether it's a pen and paper, remote offering, they've really experienced firsthand, and we've heard through our advisory board and other schools in our network, the problems they've had and the difficulty and the logistics and also the exam integrity more than anything that goes with those sort of hybrid solutions, and really the need that's come about from that for them to adopt a proper digital assessment solution. So moving ahead, so this sort of gives you an idea of the size of the market and the dynamics that are taking place within the market. And then now what we're doing is we're presenting a sort of an outlook for the next 3 to 4 years as to where we see Janison heading in amongst all of that. And we've stated before a couple of times, we have this vision and a pathway now to $80 to $100 million of revenue from the $30 million that we're at today by FY25. And that comprises, or the sort of the build to that $80 to $100 million comprises 3 strategic growth drivers, which I'll step you through. Firstly, number 1 at the top there on the right-hand side is the PISA for Schools program, which is the exclusive partnership that we have with the OECD. And we can see a path for this delivering in over 30 countries as the platform provider, generating approximately 5 to 10 million. And then in a further 3 countries as the full service national provider, where we take on a larger role in delivering around about 1,000 schools in each of those countries at $7,000, which would generate 20 to 25 million. So combined, across the platform and the full service offering, we see this PISA for Schools program generating around about $30 million in FY25. Secondly, moving down, ICAS assessments. Historically, this competition has been delivered by about 1 million times per annum, historically quite consistently, before it was digitized and before COVID. Now that it's fully digitized, it has the ability to expand into much broader geographies, and so we see this expanding further and us recovering it back to its pre-COVID, pre-digitized volumes, and that would generate around about $20 to $25 million per annum, which would be approximately 1 million tests a year at $20 to $25 a test. And then thirdly and finally, we have currently a set of about 10 large enterprise clients who subscribe to the Janison Assessment platform to run their own exams, like the Chartered Accountants, for example, like Department of Education, who use our platform to author and deliver exams to their own students and candidates. And that currently generates about $10 million a year. And we can see this doubling over the next few years to a point where we're in the region of $20+ million per annum from this this group of customers. So those 3 strategic growth drivers combine to approximately $70+ million. And then if you layer on top the point at the bottom, which is our existing business units and acquisitions, then we can see quite a nice clear path to $80 to $100 million in revenue by FY25. Moving on to the next slide, so it's the revenue, and as David mentioned, the 2 key metrics we watch more closely are assessment ARR and gross margin. And on here you can see the sort of history of gross margin over the past few years and the sort of trajectory of where we're heading. And if we continue to pursue that strategy that we've just outlined on the previous page, we can see enormous benefit from the scale and the volume of those 3 growth drivers. And we expect, as a result of that, the gross margins will continue to keep on lifting as they have done in the past few years. I don't think it would be unreasonable to expect, a margin in the sort of 70s, mid to high 70s by FY25. At which point, if you think about the sort of $80 to $100 million revenue build, generating 70% gross profit, $70 million, with a 30 to 40% OPEX rate, the business should generate $30 to $40 million of free cash flow each year. And so that's sort of a summary of our horizon and the build to get to that place. And I'll now hand you back over to David, and we'll do a recap of the 3 growth drivers in a bit more detail.
Thanks, Stu, and welcome back. It's great to have you back. Just reiterating, and you'll hear us reinforce this, I wanted to step through our PISA for Schools partnership and how we're taking that to market, where we are with ICAS assessments, and also where we are with our assessment platform, because diving a little bit more deeply into these areas will certainly give you all insight and confidence on our trajectory. Firstly, PISA for Schools, and it's extraordinary what we've been able to achieve with the OECD with the PISA for Schools. To recap, for those of you who are new on our journey, Our 5-year exclusive agreement is with the OECD, the Organisation for Economic and Cooperation Development, in the rollout for a product called PISA for Schools, and it just continues to flourish. I love this product because it showcases Janison's aspiration and purpose, unlike anything else we do. It's got a strong focus on real-world learning. It empowers educators. It drives school improvement. It's not about scorecards. It's not about league tables. It's genuinely a force for good. And it's part of, sorry, if you can just move forward a slide here, Sona, one more. And because it's part of the partnership with the OECD and PISA, the test items are unique and gold standard. There's nothing like it in the world that has the data sets to provide the kind of evidence that we can get from the PISA data set. We've built a strong and what is clearly an enduring relationship with the OECD. And we expect that we're really only at the start of what is going to be a relationship that has an enormous amount of potential and an enormous enduring nature to it. It's a low stakes test, but it's an extremely high value test, and it's fair to say that it's absolutely in demand. And so if you go to the next slide briefly, let me give you an update on our progress. FY21 saw us double the amount of countries that are enrolled to 15. In particular, notably that 6 of those 15 are now where we've been accredited as the national service provider. And I'll come back to explain that a little bit more detail. And what's important to see is that even as nations grapple with COVID, the rollout, where it stalled a little bit in in the first half of fiscal year 21, we're seeing ourselves go back to what we said we were going to do, which was, to accredit and to sign up in the order of 1 country a month. It's a bit lumpy, but on an average basis, 1 country a month. And, through COVID, we've been able to demonstrate that we can continue to deliver, including, delivering almost 2,000 schools through some of the poorest regions of Russia through rolling COVID shutdowns. We were able to deliver and create the kind of experience that schools really know and love of the OECD and Janison. And as we just look at the October-November window coming up, it's going to be our biggest delivery quarter. 1,600 schools in Russia, 200 schools in Kazakhstan, 700 schools in Brazil, a few hundred schools in China, and China will continue to run this program in spite of the legal changes over there. In the US, in the UK, it's extraordinary what we're doing now, and we're able to deliver. And we're only able to deliver it because over the last 12 months, we've scaled the team. We have a dedicated delivery organisation. We have a dedicated customer and school experience organisation. And now we're very well placed for that initial, that initial energy over the next few months, but additional demand. Just recapping Stuart's commentary on the economics before, and it's very important to note that strategic shift to becoming a national service provider in a small number of developed English-speaking countries. You'll remember that the economics would see us a quite difference between when we are the international platform partner, the IPP, where we are in 9 countries, where we provide our technology platform to a local service provider, and we can generate, in the order of $200,000 to $500,000 of annualized recurring revenue. As a national service provider, we take on greater responsibility to market it, to deliver it, to report on it, and so on and so forth. And we charge schools $7,000 per school. Becoming a national service provider represents a significant unlock in addressable opportunity. And in Australia, in the first 6 weeks, we signed up in excess of 10% of Australian schools. I can tell you in Australia that the demand continues to be significant, and even with the East Coast states in lockdown, right as we're trying to run validation, the demand is such that we're still able to build the critical mass of schools to deliver in August what is called the validation study, the first assessment window for PISA for school in Australia. COVID is accelerating demand in many ways, and we have significant system level agreed intent to test in March above and beyond, that 10% of schools. So certainly very positive momentum there. If you take our medium-term view of PISA for schools, we envisage that, a medium-term objective should be in the order of 1,000 schools. At $7,000 a school, that's a $7 million medium-term opportunity. And we expect that we can take a much more moderate aspiration in the initial stages of our renewed partnership in the US for the next 2.5 years. We can expect that in the medium term, we'll also achieve 1,000 schools in the US. That requires us to achieve 10% of what our aspirations are in terms of Australian market share achievement. And we've announced the first district a couple of weeks ago, 25 schools. What's important is that we're seeing demand in the US to lock in multi-year agreements. And so you would have seen that first schools announcement, 25 schools, 1 district, 25 schools for 5 years. And we would expect to see those multi-year announcements continue to occur in the US. We're seeing, the US, what we've been focused on in our initial marketing is to help schools understand how they can use and access Biden's additional education funds that were announced in the last few months to fund PISA for schools. And it fits, and schools are looking to see if they can lock in multi-year funding for PISA for schools from this initial Biden funding program. So, we've got local marketing expertise on the ground, and we're very confident that we will see an uptick in the US, although it will be significantly slower than Australia, and our aspirations are accordingly as such. Finally, touching on the UK, we're just entering the UK now after being accredited in those 4 countries of the UK. Schools are just returning this week. So we've got to get our expectations right and our timing right. In the first week back, we've signed on 2 schools. We've got marketing capacity on the ground. We launch our marketing campaign in the next couple of weeks, I apologise. But, UK schools have lost 12 months of learning, and they've gone through what is extraordinary for a well-being standpoint and a loss of learning. And it makes the PISA for schools proposition even more valuable, not just because it provides a school benchmark for themselves, but because of the well-being dimensions of the social and emotional well-being and the other studies that are part of the PISA for schools products, such as the Global Crisis module, which brings real and unique insight on the exact issues that educators in the UK are trying to get a handle on. So wrapping that all up, we see a medium-term aspiration of 7 million a school in the UK, $7 million revenue in the UK, 7 in the US and 7 in Australia. You add on our momentum in the IPP part of that business, which will continue to grow, and you can see a stepped trajectory to $30+ million of ARR for PISA for schools. If we continue on. Next slide, please. So many of you would have heard us talk about ICAS assessment. It's a suite of products that we acquired from the University of New South Wales in the first half of the 2020 calendar year. And amongst the suite of products that we acquired, the flagship is the ICAS competition. And it's a very aspirational competition. It gives students the opportunity to celebrate academic performance in a way that others accelerate achievement in sports and performing arts. It's got 40 years of history. It's known and loved by parents, by kids, by schools, and at its heyday had 50% market share. we see a strong trajectory to take ourselves back to those highlights, and that was evidenced by what we learnt in FY21. Despite the impact of COVID, the ICAS competition plus the Reach product in 2020 sales cycle exceeded our most optimistic expectations: $5 million in revenue, 300,000 tests, 2,500 schools, and notably a 98% improvement in customer satisfaction. And, you know, we expect to continue to enhance the product, continue to improve delivery. We've started a very strong ICAS 2021 campaign on the back of a very successful rebrand and reinvigorated marketing campaign. And it's been a very successful plan to date. The business is poised for growth in FY22, and we see that continuing to have a growth trajectory, both domestically, but now we're fully digitised and online. We've really started to unlock the global addressable opportunity. And finally, if we go to assessment platform, thank you, Sona, and we've covered the assessment platform earlier on in this conversations, but we're really encouraged with the uptake and the expansion of use of our assessment platform. We, as I shared before, we signed 6 new logos, notably chartered accountants, and we've run a very successful first term chartered accountants capstone program. It's fair to say that our customers across the board are really delighted with the experience they get when they work with Janison. It's our platform combined with our knowledge of running high stakes events, our systems and processes and tools that combined create the Janison product that large jurisdictions and institutions and accreditors know and love. And I just wanted to highlight one, if we go to the next slide, Sona, one that I'm particularly proud of, and that is our partnership with the New South Wales Department of Education for Check-In. Through the midst of COVID last year, the Department of Education was desperate to understand the amount of learning loss in school children as a result of COVID. And so we developed with the department a product called Check-In. And Check-In was an opt-in program that provided immediate data back to schools, immediate being the next day, that could be filtered by cohort, by year, by subject, by class, and so on and so forth, to pinpoint learning gaps and provide teachers with the evidence that they require to stage the interventions that they need to do. And what was very pleasing is, this is an example of 21st century assessments. It's an example where the likes of the New South Wales Teachers Union saw this as an enlightened approach to assessment. The Grattan Institute considers this the best quality data set of learning loss through COVID to date. The Education Minister, Sarah Mitchell, called this out. We ran 650,000 students over 6 years, twice last year. And our expectation in 2021 fiscal year that will be extended by the department, not to 6 years, but to 7 years, and again run twice. So you can see that we've got very strong relationships, enduring business, and very clear organic platform growth in these key growth areas. So I think we'll now, Stuart and Sona, go to 10 minutes of Q&A. If we step through to the next slide.
Great, David. Thank you. We will now continue with our 10-minute Q&A session. Please feel free to post any questions you may have for David or Stuart in the chat on the right-hand side of your Teams window. And if we do run out of time in this session, we are happy to answer any remaining questions offline.
Angus, I saw you put your hand up. Please go ahead.
So your microphone is muted. So if you do have a questions, I want you to ask you to formulate this one in the chat function.
I can see we've got a question come through here, so I might just answer that myself. It's just around how would, if there were further acquisitions, how would they be funded? Or maybe I'll just answer the first question. Prior to that, by Brett. Thank you, Brett. So, any further detail on potential acquisitions? Oh, look, I mean, we are progressing. There's obviously COVID is causing some concerns with some people, but we are progressing, and there's nothing concrete. We do have one in particular we're very close to, and it is moving forward, albeit inching forward slowly. Yeah, nothing to announce at this point, unfortunately. But and also a pipeline. We do have a pipeline of a few other deals as well that we're looking quite closely at. And in relation to that and other acquisitions, would they be funded from cash or scrip? It depends, I guess, on the deal and the owner and the kind of owner that we're dealing with, or the vendor. We definitely have more cash on hand, and part of the acquisition was to help make speedier acquisitions through having more cash available. I think it would be a balance. We do like to lock people in with some scrip as well, in an escrow period, just to help sort of align our interests. So it would be a combination, and generally that's what we've done in the past, a combination of the two.
Thanks, Stu. Why don't I address the next question from Alex about the pipeline of new logos going into FY22. And look, it's positive, but let me just frame up where we stand. As you'd know, Alex, because you've been following us in detail for some time, we said, some 14 months ago that we would lift our sales and marketing spend from circa 8% of revenue to 16% to expand share of wallet in our existing growth engines and pursue new logo opportunities. And you can see that strategy is already playing out. So as you look at the expansion of our PISA for Schools program to the national service provider and to the existing IPPs, that's a product of our sales and marketing investment. Similarly, the growth of ICAS and what we expect to continue to be sustained growth of ICAS into next year is a function of our investment in sales and marketing, as are the six new logos that we signed up on our assessment platform. I expect that we will sign up a modest number of new logo assessment platforms. We're very focused on getting those customers right. We want standardized customers that come on our standardized platform that are of scale, that really fit our use case, which is high scale, high stakes. The pipeline represents that. Both domestically, but encouragingly, we're seeing some strong pipeline in new markets that we haven't necessarily done significant business before. And, I expect that we'll be able to talk more about that in upcoming 6 to 12 weeks. Stu, do you want to take the next couple of questions about development spend and impact?
Yeah, I just noticed, do you see the one on the higher ed and workplace? Do you want
to... Okay, let me cover that. Yeah, look, it's not unexpected that our higher ed and workplace revenue has gone backwards year on year. A large portion of that revenue is associated with our in-person exam management business, GEM. GEM has been affected domestically because in-person exams have been affected through COVID. Pleasingly, and you don't see that in the higher ed and workplace lines, you see it in the assessment recurring revenue line. Pleasingly, what we've seen in contrast is the movement online in the higher ed space with the likes of SCIO, the University of London, and so on and so forth moving online. So the market trends would suggest that it's only accelerated the initial thesis of our acquisition of GEM, which is to take higher ed customers online. That said, our core focus is schools and higher ed.
Yeah. Just moving on this, so the next question was around when we expect to be impact positive. That's FY23, not next year or close, but it really sort of takes off from 23 onwards. Will we continue to spend 6 million on development? Yes, and maybe a little bit more. You know, there's a lot that we can do in our platform. There's further functionality, reporting and dashboards. In the area of product development, we also include assessment products, so building out off-the-shelf school assessments. So that's something that we know will become more part of our strategy as we sort of build out our subscription model for schools and parents. Questions on OPEX trends for the next few years as we expand PISA for schools and ICAS. What is the OPEX trend like? OPEX will sort of leveling out this year in FY22, but then will start to come down as a percentage, but we'll keep investing in OPEX as we build out certain parts of the team, not extensively, but on the whole, you can expect to see the percentage of revenue for OPEX falling over the next few years. We're projecting 1,000 schools in EU, US and UK, despite different market size in terms of number of schools. Would you explain why that is? Also, on a combined basis, the assumed market share is just 10%, being very conservative. Do you want me to answer that, David, or do you want to have a crack at that?
I representing time, Kate, you're on the mark. We're being very conservative. You know, these markets are less known to us, and we want to make sure that we really understand the go-to-market, the approach, the value proposition, you know, and with a good handle before we take a more aggressive position. You know, Australia, we know the market very well, and we've got very strong installed base, including a go-to-market with our ICAS business. But you can expect, you know, that while it might take a number of years, as we get more confidence in those markets, we'll take a different view.
Cool.
We might take one question, Stu, and then
yeah. I think I can rattle these off quickly. So the next one from Mike is around the seasonality of the business. So we do have an underlying first half weighting because of the ICAS competition and the size of that in the first half. But because of our growth rate, what we're seeing is new business, new acquisition of clients come through in the second half as well. So as we continue to grow, it's actually pretty balanced now. And I think we made that point a little bit earlier on that our revenue is pretty flat year on half. But the underlying is definitely higher in the first half. Details on Janison Assessment Platform and how does it provide identity validation and in dishonest behaviour? Look, there's a whole range of things within the software. Obviously, initially there's ID checks, whether that's through AI or through a human invigilation that identifies the student through their identity and their identity card. But then throughout the exam, the software detects various things, whether it be simple things like people moving around in the background. It could even be more complex, like students' eye movement, and if they're focusing away from the screen. It can be things like their character speed and character pattern on when they're typing, if there's any anomalies there, and all of those things are flagged throughout the video. And so either a human invigilator can monitor it as the exam's progressing, or they can review it afterwards and review those moments in the video footage where there's been potential dishonest behaviour.
All right. Sorry, Steve. I might call it at 12 o'clock. I'm very sensitive to everybody's time, and we're starting to see some people have to obviously have to drop off. It's a busy reporting season. So I once again want to thank everybody for joining our investor update. I couldn't be more proud of our results or our team in FY21. And, you know, as I look forward, I feel like it's going to be an incredibly exciting time for Janison. We've announced good results. We've matured our capability. Our transformation and our focus on our growth engines is very clear, you know, and as we continue to focus and deliver on our purposes, I can only see us continuing to sustain the momentum. So thank you very much, and we'd be very pleased offline to answer any additional questions you might have.
Thank you, everyone.
Thank you very much. Bye.